Alrighty. Good morning. This is Axel Merk, President and Chief Investment Officer of Merk Investments. And I am trying something a little different today. I've had several requests to use some charts. And while we have various compliance restrictions on our usage of charts, I can use a report that we just published, our research report on the equity markets, as a basis to do this morning's live comments. And so before I do that, let me just give a quick update here on the market. The S&P futures are up currently at 45, and the bonds are a tad weaker. 10 years down 5 ticks, the 30 years down 15 ticks. The dollar is broadly weaker. The strongest currency is the New Zealand dollar, the Kiwi up 1.1%, and the weakest currency is versus the dollar is the sterling in the major currencies. That's only up about 20 basis points. Gold is up 450 in the spot market at 1750, and the gold futures are up 780 at 1753. The 3-month T-bill is at 12 basis points, and the 3-month LIBOR rate is at 38 basis points. Fed funds rate at 5. And so, with that, one of the things we publish is our research reports, including once a month an equity market report. Obviously, with all the things that are happening, some of these charts are completely out of whack. You probably can't read this. That's all right. You can the small print. You can download the PDF at merkinvestments.com/research. And these we usually publish a PDF, a premium PDF, and then I do publish an analysis that is behind a paywall. And so today I'm giving you a different analysis that's not behind the paywall that you can listen to, but I very much encourage you to look at these reports. And I'm going to use them just as a guiding post. I'm not going to try to repeat the same things that I'm saying there. I'm going to go through some of them to just make a comment on some items. The global growth backdrop, I'm going to use that as an opportunity to say two things. One is the expansion starts once we've hit bottom. And so we tend to forget that. We say, oh, this is going to take a long time and so forth, the crisis until we're out of the woods. Well, yes and no. By all means, I'm in the camp that thinks that this recovery is not V-shaped because of all the ripple effects of a lot of businesses going out of business. But the moment you have positive growth versus the previous period, you're talking about growth again, right? It is no longer from that point of view, the recession is likely going to be short. Talking about companies going out of business, I listened to German news this morning, which I try to do most days. And there's talk about whether startups should get a bailout. No, by all means. I live in Silicon Valley. I've seen many startups. I've seen many startups fail. And in fact, I have friends who've lost jobs because the startups are cutting back. And clearly funding isn't available unless you do something that is very much related to this crisis. So, but that is kind of part of what it is to be in a startup. Startups do hit walls periodically. I remember vividly the race in 2000, multiple occasions that you go full speed ahead and then you either get funding or you hit against the wall. There is no such thing as a bailout for those entities, but obviously in Germany they think about that a little bit differently and they say, well, why don't we make it dependent on the business plan? So, I mean, it's an odd world out there. And we are going to be. I have no idea whether it's going to come to fruition. I have my doubts, but it's just one of the signs of the periods I guess we live in. Financial conditions. This, by the way, is our equity market report. And so the idea here is that to get a bunch of indicators to see where we are. It's very difficult at this stage to decide whether the glass is half full or half empty. Obviously, the S&P 500 is again up today. We should also look at the bond markets. They've been reasonably well behaved. The stress in the market has come down. But there are good indications that not everything is well, and we know that, right? Now, the backdrop is, of course, that in 2009 we hit the bottom in the market in March, and then for 10 years we had a rally, and everybody hated the rally, everybody missed it, and so now there's the fear of missing out. Everybody jumps on board, and the question is, should you be in the market? And this is an investment advice here. think I can even with this one here give you a disclosure that I just throw in there here briefly. I have a disclosure at the end of this presentation as well, but let me just put this one in there as well. The access to funding for corporate America has gotten better, but if you are trying to get a HELOC, a home equity line of credit, for example, that's currently difficult because some banks temporarily are out of that business. And so access to credit is more difficult. There's been testimony with Powell and Mnuchin about the corporate facility, and that's really a can of worms. It's going to be very difficult, in my view, to do this in a way that's not going to be completely politicized. And so, from what I can see, I think the Fed would be well served not to get into that business. But apparently, they're committed, and fear not, politicians are going to request money to be doled out to various people, and then complain about the ones that were supposed to be doled out. So, Elizabeth Warren, for example, suggests that companies must use the money to retain people and must not lay off any people if they get government money. That sounds good, but that means that the money is not going to make it to the businesses that probably need it the most. If you take the airlines just as an example, they cannot possibly, unless they get so incredibly much money, to kind of get through this without some furloughs, layoffs, or whatever you want to call them. But lots of reasons to get this politicized, and that's a lot of the reason why the Fed shouldn't be part of that. Money printing, what else am I telling you? This is a chart that shows the market breadth hasn't been as diverging as one would think. Somebody pointed out today that as of late April, small caps have been doing better, but this year is just the S&P equally weighted versus the market cap weighted index, and not that much of a divergence, which means that we don't have too many signs of, if you use that as an indicator, if you could have a bullish or negative divergence. You had a bullish divergence if you had the equally weighted ones make new highs, but the market cap weighted not, for example. Market sentiment, the AAI has a weekly survey finally reaching some really bearish levels. There are many issues with this survey, most notably that it's kind of a self-selecting one. You have to go to the website to put in your views, and historically it has had a reasonably good track record. But there are other sentiment indicators that suggest that investors aren't actually all that bearish. There are different ways of looking at margin debt, but that continues to come down. And it was like with many of these prediction things. It was a good predictor in 2000. It was a good predictor in 2008. That doesn't mean it was always a good predictor of the next downturn, and that is part of the reason why we look at many other things. This is too complicated to explain right now, but what that means is that in a panic, these two charts, this and the previous one belong together. In a panic, you have a high volatility, and the correlation of different asset classes kind of are moving towards one. And that's what this is visualizing, and that's as a contrarian indicator. When these things are very high, it tends to be more on the of a buy signal. The wall of worry to climb, a big wall of uncertainty here to climb. The VIX curve, I've touched on that on several of my morning briefings here. Just right now, the VIX curve is positive. The spot VIX is at 28.32. In a panic environment, you're more fearful of the present than on the future. That's when the gray bars are negative. In a more normal environment, it's kind of the future is uncertain and the present is certain, relatively speaking, at least. And so we had been dipping in and out, and on a closing basis, it was more difficult to get to the positive. And so that is a sign that we are normalizing a little bit. We're below the 200-day moving average, just as a glimpse. By the way, there is a premium chart book as well that goes far more into detail, shows some COVID charts and shows some, so also on the technical side, more charts, a whole bunch of other charts that you might have an interest in. This one here is an indicator it's really an autocorrelation, so the predictive value of that is questionable. But this one suggests that over the next 10 years, the S&P might not go anywhere. And what it really looks at is, compared to historically speaking, if you take all equities outstanding, all fixed income outstanding, what's the relationship between the two? And there is an autocorrelation 10-year forward about how the S&P might be returning. Again, this is not investment advice. And here a reminder that on a calendar year basis, returns are all over the place. This chart here was done on the 15th, so we've always moved from here, but we're only down 11% from for the year here on the S&P 500, and so you wouldn't know that if you just looked at the markets here based on the context of the crisis. Anyway, if you look at this checklist here, the net result, I don't know whether that's all that helpful, right? You're neutral with high uncertainty, both short and medium term. But by having a checklist, it's a way of having a reference point where one is in this cycle. And we can't give a specific investment advice here in this forum. If you want to have somebody help you, we can possibly do that. Come to our website and then let us know what your situation is, and then maybe we can help you. We do that on a very limited basis. But the more general thing I can say is that having a process is so very important. Because as you have seen, right, we have some days where the market is doing well, and this is, oh, I got to be invested, I got to be invested. But why, right? And if you are young and have a long planning horizon, part of the reason why young investors can take more risk than old investors is because you yourself are an asset as well that's income generating. And so odds are that your income generating power is very significant at a young age, especially compared to your savings. As you get older, expectation is you're going to be earning less over your lifetime. And the nest egg you've built is a bigger portion. And so that's why if most of your wealth is in yourself, meaning your future earnings potential, it doesn't matter as much what you do in your investment portfolio. Whereas it does get more important as you get older. That's just one way of looking at it, right? The point about process and discipline that I can't stress enough is that a lot of people say when the market's down, invest, invest, invest. Well, that maybe, right? That works if you do the rebalancing part when you're at the market top. If you haven't done the rebalancing part, you may have lost too much. Or let's say you use leverage, right? The situation may be very, very different. You may have lost much more than you could afford to lose. So anyway, let me just look at here. This is, I believe, on this chart here. Again, please download the PDF at merkinvestments.com/research. Nick produces these charts. He is also on Twitter, Nicholas T. Rees. Follow him and follow me, obviously. If you don't, at Axel Merk is mine. And here is also a disclosure. I've shown you now 2 disclosures, so I think that's plenty of disclosure here for right now. And let me just see here whether I can move to, here we go. I can move to my regular format here to give you some more indications. Let me get my Bloomberg back in front of me. And so again, for context, I can't just share my Bloomberg screen and I can't just share any charts with you because they'd have to go through compliance. I am regulated and everything I say is censored in one way or the other. By sticking to this free flow format and not talking about products we have, or not talking about specific securities too much, or very differential contact without giving a recommendation or anything, I am able to communicate with you. As I talk here, the dollar is weakening further. We are at the euro now at 109.95. Let me talk about one thing in the eurozone that I don't think has gotten enough attention, is that earlier in the week, Merkel and Macron agreed that some joint EU debt could be issued on a temporary basis to help finance, to help support the Southern European countries that were hit particularly hard with COVID-19. And that's a huge, huge game changer if that is the case. This is like in the US, we issue federal debt. In the Eurozone, you don't do that. It's always the states that do it. The European Union is not the United States of Europe, and so a crisis like this might get Europe closer to that. And so there is some relief there in that sense. But the euro is only in the middle of the pack, so to speak. The euro is up 70 basis points. The kiwi is up 122, as I pointed out, with the yen up only, quote unquote, 28 basis points. So the yen is near the bottom of the pack. So as the crisis is moving into a more normalcy, the flight to quality into the dollar might abate. I say might, because obviously there is no assurance that that will take place. But there are several things that opt for that. The U.S. is just a more dynamic economy, also aside from the flight to safety that's passing away, and so we may well introduce more stimulus that is more inflationary also go down the road, especially. I was asked yesterday about the election outcome. What about if both House and Senate and presidency is going to be in the hands of the Democrats? And to me, this isn't as much about it being in the hands of the Democrats or the Republicans. It is if you have no opposition, if you have uniform control of legislative and executive branch, odds are you get much more done. Most notably, you get much more spending done. And the sort of spending that's being considered is much more inflationary than the spending that had been considered in recent years. A corporate tax cut is not as inflationary as infrastructure spending or direct payments. If you give money to people that actually need it, odds are they'll spend it. And that may be all good politics, but it may also be inflationary. And so I think that I was asked yesterday that as I once said months ago that inflation may be the most underpriced risk in the market. I think that's I don't know whether it's the most underpriced risk, but it is very much of an underpriced risk in the markets. Um, and in the short term, inflation has come down based on the official readings, but the official readings are bogus because people don't drive. When people don't drive and you have a big percentage of gasoline in the inflation index, it's an interesting data point, but inflation it is not. Um, and clearly there are disinflationary pressures, especially as we keep so many businesses alive. And that may be a good reason to keep them alive, right? But as we keep them alive, they may be overproducing. If you take the automotive industry, right? A lot of people cannot make the lease payments. They hand the key back. And now what? You got the second-hand market swamped with cars. And so is there going to be great demand for new cars? I don't know, right? I mean, maybe there is. I yesterday on in my mailbox there was a brochure of a house for sale, um, and the listing price was over $1,900 a square foot. Now, I live in Palo Alto, where prices are very, very high, but this doesn't sound like prices are coming down. It's just incredible the sort of price that they are, right? And so who knows? Maybe we'll see some bifurcation in the market. What does appear to be is that vacation resorts, some of them may be big beneficiaries. People are going to do fewer international travels. They're going to probably, I mean, I'm making this up here as I go, but it's if you may not feel comfortable flying somewhere, and so you're going to drive somewhere. And so if you're in New York, you're going to drive to the Hamptons. If you're in the Bay Area or in Los Angeles, you might go to Lake Tahoe. Obviously, you might take the virus with you, but other than that, um, these areas, the Airbnbs who are there, they may well benefit from that. I mean, they've suffered now for a few weeks and months. Not suggesting that all Airbnb customers will be happy. Those that borrowed apartments in Manhattan or whatever to try to make an extra buck, they probably are going to be suffering for an extended period, and many of them have overextended themselves. Any case. Let's see, anything I did not mention that is worth mentioning. Oil I didn't talk about. 33.45 for West Texas, up 4.5% or $1.50. And similarly, Brent is up almost 5% at 36.37. And so those are quote unquote normal values again, as some of that oversupply is being worked out. Good. I'll leave it at that. Have a great day. Be safe out there and talk to you soon. Bye.